Hi, everyone. Good turnaround Tuesday. How's everyone doing?
Morning, Dale.
Morning, Ryan. How are you, buddy?
Yeah, not too bad, mate. Yourself?
Pretty good. Up before the roosters crow. So Alexander, Brock, Ingmar, everybody doing okay? Jays. Okay, so
Morning, coach. I see a black screen. I don't know about everybody else.
oh, okay. Well, I'm gonna.
I see the same. So thanks, Del. And good morning, guys.
Anyone else see a black screen?
That's good now. Thank you,
Yeah.
coach.
Okay. All right. So let's look around. So getting a continuation move in Euro. Talked about 1810. If you guys were here last week before Powell, I said I thought that we could get a move towards 1950, and as long as we're holding 1810, that would be a measured move. And the anchor of the wedge is up here. So if you believe in the rule of 100% retrace on wedges, that's a shade under 119. Who knows? Maybe we're going to challenge this moving average up here at 120. That's going to be a battleground for the longer term dollar bears. If they could get the euro close back over 120, I think that could change the longer term picture. But I'm thinking this is just one more bounce, and then I'm looking for one more low in the dollar. But let's stay with this. So even if you're a long-term dollar bull, I don't think you could fight what's happening here. Also, euro stronger than cable, as expressed by EG. Still looking okay unless we start closing back under 40. That might change the picture. Otherwise, we could still have a bear market rally up towards 87. Yen is holding up better than the dollar, but it's an I don't know for me. You could see up here that there's a potential for a third drive if we got going, but I look at this 10-year and still could be okay. I mean, trend lines, what the guys, Blake and Stell and Ryan, do you know what the destiny is of a trend line?
Destiny of a trend line?
Yeah.
No. What's that?
To be broken.
There you go.
Eventually, they all are, right? Okay,
Yeah.
so I mean, I don't trust trend lines as much as other things, because you could poke through them, and you could always readjust your line to make it fit to whatever your bias is, right? So anyway, dollar still continuation move with the euro, and starting to get a little bit oversold, but I still think we're headed towards this 91 level, 90, and then we'll see if we could do this one more time into the fall. How about that? S&Ps are actually a little lower, maybe turn around Tuesday in equities. They got in my face yesterday again, but gutting it out here in the S&Ps, down about 13 handles. So we'll see what happens there. Gold and silver is interesting. The gold is, some people are saying, well, maybe this was a top. It completed a 5-wave. I know nothing about Elliott wave except things that are dangerous. And if it is, this could really set up a nice buying opportunity if we get some type of fib retracement off the flash crash here. I'll be looking at gold 1750-ish. I'm almost tempted to short it, but I haven't yet. I haven't done anything. And keep in mind that a lot of what's going on right now, especially next couple of days, is kind of book squaring and jockeying for position on the NFP. So I think the whole week is going to be made on that number. So 2 very important Fridays in a row. And what's interesting about Friday, at least for me, is I'm usually exhausted by Friday. And that's when you have to be on your toes. You kind of, for me, I kind of let go by then, because I think it's a book squaring day. But when you have NFP and the debate in rates and Powell's speech last week, I think, I don't know about you guys, don't you think this can be one of the most important NFPs in a while?
Yeah, I think they all are. I think they all are for the rest of the year. Basically, they're all going to
Yeah,
be
okay.
important.
Okay, so what else would you like to talk about, Ryan, with the euro, EG, anything out there that's capturing your interest?
Yeah,
You've been back for a day, so
back for a day.
you're in the saddle again, buddy.
Yeah, that's the downside with being away and switching off from markets. You come back to a big pile on your desk that you got to sift through. I'm still going over the charts, trying to get head or tail of what's going on. But markets are moving, and the first thing that caught my mind, as we spoke about yesterday, is bond yields. Looking at the tens. I said if it gets below 130, that could create some more dollar weakness. And now we're below 130 and holding below 130. You can see there we've got resistance there today.
Yeah, right there.
And as you said, it's helping lift euro dollar higher. It's creeping up, and
Right.
over 1850. I think you're going to be getting your 1900 and perhaps more.
Okay. Yeah. So I mean, this is really the whole demarcation zone of the next move in yields is whichever way it comes out of this range. It looks like to me. Where's that line? Okay, this 113. Maybe this is going to be important, but 136. Obviously, if we get through there, you could have a pretty good move. But right now you just have this range. Maybe you could pull it up, and it needs to hold 120. Under 121 and a half, we're probably going to test 113 again. So this is what in the middle of a range here. You could have a bias, but it's a coin flip trade to me right now.
And that's been the case for a while now. It's just the consistent indecision. Bond markets, as you well know, historically, Dale, they tend to lead, so they tend to trend a lot, and they cite what's going to happen in the economy. They cite the fundamentals, rates, and so on and so forth. But right now we're in a real period of indecision over what the Fed's going to do. I was looking at the CFTC positioning yesterday.
Okay.
And this is from last Tuesday. Yeah, we had some bond options rolling off and the roll and things like that. But the positioning, it's modestly long, I would say, overall between the financials and the speculators, but nothing that you think, oh, this is a trend. And we saw 31,000 odd longs collapse or bail last week. And it's up and down. You're seeing this movement, but what you want to see is a trend. If you get a trend in bonds, you get the trend in yields, and you follow the macro picture follows along with it, and as do currencies. But it's this big indecision. So really, we are range trading at the moment because we want to know what's going to happen with the Fed.
Right, and this oil. These have been tough markets. Because there have been so many false breakouts and breakdowns. I mean, I was convinced after this breakdown that, there were much lower levels than this, although I took a shot down here. But when I took a shot down here, I thought I was being aggressive looking for 65 and a half back to the breakdown, and it just blew through the breakdown. So, and then up here, I can't buy it. Maybe you just have to, energy is going to be big. I think this is a big pivot point. Above it, I guess you have a long bias, and back underneath it the other way. So crude again, like the 10-year. There's a lot of them either or. It could go either way. And since breakouts are being negated, you don't know what to trust out there.
No,
right?
exactly. Yeah, and you've got to let the levels decide. You got to let the levels decide, and where you get multiple supports or multiple resistances, that becomes your range. Whether it's short term or longer term.
And just one look at the VIX market at all-time highs, and we didn't even take out this low yet, way above this low. So I know it's probably, a lot of people don't think it's a tell, but I still do remember the days that every time we were on a run in risk that we would, trade, beneath 12. So, I mean, it is a new regime in VIX, and you would have thought that we at least would have taken out last week's, this low with the blow off move that we, had in the last, look at the RSI on some of these things. So, I'm breaking my rules by staying short because, you know, we have confirmed highs on a lot of different time frames, barely confirmed on the 4-hour. But, you know, maybe you get a pull back to 44.80 or something like that. Looks like they're, you know, the market's due for some profit taking. So maybe that's it. You know, I still think that there's a chance for maybe this could set the stage for some type of correction. Let me bring up a name from the past. Anyone remember Larry Williams? Famous in the 70s and 80s of how he turned 10,000, wrote a book, How I Turned 10,000 into $1 million. And he's looking for a buying opportunity in the market in October. So I don't know if it's going to be 5, 7, 10%, but I think there'll be something that'll be a better time to buy stocks if you're bullish than right now.
It could well be. I mean, look at that dip we had, you know, a couple of weeks ago, and
okay, so the
longer term chart there.
Yeah, see, so some of the old timers have Larry's book. I think he's in the U.S. Virgin Islands now. So that's it. Curious as to what the rest of the team has to say. Stell, I haven't, you know, heard you in a few days. Anything striking your fancy here?
Well, for me, I mean, for me, the story is still the same. We are seeing inflation. It's not transitory. I don't know if you guys saw Eurozone inflation this morning, 3% year on year. Last print was 2.2, expected 2.7, 3%. So it's all very transitory, not. And you're seeing aluminum, as you guys say. It's up to 10-year highs, and you know, all this is just pointing to more. I don't want to say more inflation, but you know, inflation is not going to go away. So at least not in the short term. And I've been saying this for a while. I have some friends who are in shipping, and I saw them yesterday, and they said they're laughing. They're saying, "Look, this is fantastic for us, and it's not going away." And these guys are not stupid. So they're, you know, the understanding is that we have at least a couple of years of you know, high inflation and this situation just persisting. The question though is, you know, why are we having this inflation? This is not pure demand based inflation, far from it. It's because we have supply issues and but you know, bottom line is materials are expensive. And so producers have to increase their prices, and we're also seeing earnings going up. So you saw the last UK average earnings growth was around, I think it was like 8% year on year, something.
They're passing on the price increases.
Yeah, exactly. And in the US as well, average hourly earnings last time, I think last print was around 4%, if I'm not mistaken. So this is not just something that's going up and going to come down, because you're seeing price increases, you're seeing wage increases. So you know, I find it crazy that bond yields are down here. I really do. I don't know what the markets are thinking, what they're pricing for the next, you know, year or two. But, you know, 10-year US below 130 and 10-year bonds again going towards, what is it, minus 40 basis points. It's for me, it's insane. But, you know, you guys know me. I'm looking to short all these. I still have my target 178 in the bond. You know, we're not there yet. I think we're going to get there. And but you know, I think being short bonds is the right trade, but timing it is very difficult. That's the only issue.
I know your friends are getting a lot per tanker, but doesn't it affect them? Like I saw there's a new record in, I don't know if it's Los Angeles port, a record 44 tankers or, you know, freighters just sitting out there in the water.
Yeah, that's a big problem. They were telling me about this. That is a big problem. But in the grand scheme of things for them, you know, obviously it disrupts things, but this is a situation they would love to have for decades. So
well, if they need to adopt a grandfather, give them my phone number. Okay.
Hey, get in line, man. I'm first.
How you doing today, Blake? How's it going, man?
Well, good morning. How you guys doing?
Morning. Good, good. What's new? Cooling off there in Arizona yet?
You know what? It is not. So,
okay.
It's still hot
a
here.
little bit.
Oh, good. Well, maybe it's coming our way then, since
Yeah.
you live west of me.
Yeah.
So, I was just taking a really good look at the euro dollar, and this is our chart of the day yesterday. If you guys don't know where to find that, if you are, you can just go to our blog, which is at forexanalytics.com. Just go to where it says blog. Here's the chart of the day if you don't follow us on social media. And I was looking for a move above this 118.10 resistance, which we broke overnight. And we hit the 127% extension. Ultimately, I think we're going here to 119. But I'm, I always get a little skeptical on, well, first of all, Tuesdays,
we're in agreement now. Does that bother you a little bit?
No. Well, I always get a little nervous after Mutual Fund Monday. I mean, you have Monday where the market just kind of rips higher equities. Tuesday, we might get some consolidation, or, because the market doesn't pull back, so we might just get consolidation. That might be it. But no, and jokes aside, if stocks stall up here, I'm going to be a little bit worried about trying to chase the euro higher at this point. But I just want to point out that we have this, we're in the wedge in the S&P. We were looking for 45.50 yesterday. We got 45.45 today. The top of the wedge comes in at 45.65 from here. But, we can always just fall short of that. Wedge
where's
top.
that line that it broke above, like a throwover line?
Right here?
Back,
it's about 45.15 or so. Okay. I mean, if we got back below 4,500 or especially like 44.70, I would be a little concerned with equities. But it's bullish. What are you going to say here? Oh, I'm going to get short. Okay. I get good luck. I'm not getting any type of bearish until we're solidly below this trend line here, but that doesn't mean that you can't be cautious. And this is the point of seeing wedges. What happens with most people is they get caught chasing the market higher, and then all of a sudden the bottom falls out and then they get stopped out. And then next thing you know, we go back and hit a new all-time high, a couple weeks later. Same thing could happen here. We're hitting all-time highs. We could very easily reverse from here, trade back down towards 44.30, 44.50, and then, bounce again. So, can you play it counter trend, with risk? Sure. But the reason why I point all this out is because, if risk aversion, well, it's a risk aversion. Let's just say we see a pullback in equities, and let's say we pull back, 50 S&P points from here. The euro is going to have a tough time, making it to 119. So, at this point intraday, this is the way I look at euro. Just wait for it to drop back here. As Stelios pointed out, Eurozone inflationary data is not transitory, and it came out pretty strong today, right?
Yes, it did. I don't know if you trust it. Yeah.
So if and I'm not necessarily up on playing the euro against the dollar, so to speak, right now. I'm more in tune with playing the dollar on some crosses. So the dollar to me is I got at the end of the week, I think I got a little bit of a bad taste in the dollar, and I kind of want to wait till the jobs report this week. If you guys don't recall, last week I was actually long some dollars going into the Jackson Hole speech, and I had some decent profits and watched them all basically get evaporated after Powell. And I'm like, that sucks. And so this week with the jobs report coming up, which, as Ryan pointed out earlier, it's going to be important, and it's going to be important. Every jobs report from here on out is going to be important this year, because we are data dependent, as Powell said, and we are going to be really everybody's going to be focused on inflation data and jobs data moving forward. So the dollar really is going to matter come Friday. So I'd rather just play some crosses. And I know like Ryan has a longer term euro sterling short, or at least he's bearish longer term, but near term, like this is one of those currencies that I think you can play to the long side. I'm long currently, but we had a false breakdown a couple weeks ago. And I think we could very easily trade back up towards, mid 86, maybe closer to 87 pence on this bullish pennant. And let's say we get some risk aversion. Let's say we get some stocks pulling back a little bit. Well, the euro tends to outperform the sterling in that situation. So you can look at the euro sterling as a possible long. Another one is the euro yen, and the euro yen. If you guys think that stocks are going higher from here, play the euro yen to the long side. We came out of this bearish channel, this descending channel that's really kept us all summer long. We hit the 13-year trend line last week at like the 128 level, and we've been strong ever since. And we're trying to do a bullish breakout right now above this resistance. So, and we have this like wedge that just broke out. So if you buy it below like the 29.90 level, it's a decent risk reward for longs if you guys feel that stocks are going to go higher. So I think there's other opportunities right now to play the currency market other than the dollar. I know some of you are just, adamant about playing the dollar, but I think there's some great opportunities around, and you don't have to necessarily stick with the dollar at this moment. So anyway, that's kind of some things that I'm looking at today in currency land. And Ryan, let me ask you this really quick. I don't know if you're still here, but how do you still feel about the euro sterling? You still feel that you want to be long sterling? And the reason why I'm asking you is it sounds like the UK's got some supply issues right now that is more than Brexit. So what are your thoughts there?
Yeah, I'm still short. And I'm on a long-term trade, so I'm playing the
right. I was
England.
I was going to say you have a long-term euro sterling short, and you're short from way higher levels. I'm just asking, like, near term about the sterling. How do you feel about it? With, like I said, there's some supply issues that are coming up, and it's more Brexit related than China related, right?
Yeah, in the short term, you're 100% right. We got that false breakdown, and that was a break I was waiting for below that 84.80 for my shorts, and I took a bit off when we did break it. But like you say, we couldn't hold it, and if we can't make new lows and can't cement the break, then we're going to go back up. In terms of sterling itself, generally, yeah, there's still some Brexit related issues, but a lot of fingers are being pointed at the supply chain issue. It's all about drivers, lack of drivers. But I put a headline in the newsroom yesterday. It's not just a Brexit problem or a UK problem. Poland has got bigger issues with drivers than we have. Germany, Italy, Spain, they've all got issues, and that's affecting the supply chain more than just Brexit. But as you say, talking specifically from the euro and sterling perspective, for me, it's still very much the central bank divergence. The Bank of England are, if you like, getting their nuts squeezed. We're coming to the end of QE. QE is stopping automatically in December. It's not like the Fed or ECB where it's open-ended. It's stopping. So the next question is going to be rates. There's no two ways about it. It's not like, as I say, like the Fed or ECB. You still don't know when QE is going to end, and then you don't know when rates are going to end. The question moves automatically. End of December, it moves to rates. And if inflation keeps going as it does, and if economies still, plod along and do well, it's going to be all about the rates, and that's going to bring in the divergence of policy. And if that's the case, euro sterling could be at 87, 88. And if we're there when we're looking at coming out the end of QE, that's potentially where you're going to be looking to go short and get that next ride. But as soon as the market's jumped on the back of that and predicted rate hikes for the BOE, that's the time you want to be looking to get out, not when they actually move on rates.
Okay, all right. Well, that's some good intel there, and I know Stelios just mentioned about inflation, and inflation pressure is going to be hot and heavy everywhere. But let's see if Steve is around. And Steve, if you were here, how are you feeling about the inflationary pressures that globally as well?
The same way I felt months ago. Yeah. It is an inevitable
Make a recording.
outcome. Yeah, I mean, you just need to press play, right?
Hey man, I was giving you an opportunity to say something, so here you go.
Yeah, it is an inevitable outcome. We first had inflation manifesting in price in asset prices, right? Because of a Cantillon effect, that's where it got injected. And since COVID, that inflation, which means monetary supply, started getting injected in lower levels of the economy as well. We now see inflation manifesting in everyday prices as well. I think there is absolutely no way that this is a transitory phenomenon that's going to magically go away. But on the other hand, the Fed and the rest of the central banks are completely unwilling to do something about it, because that would mean the implosion of the so-called economic recovery. So they keep pretending that they're willing and can do something about it, and until this stops working. I think we've got to the point that the day of reckoning is not far away. It's not easy to predict if it's going to be in, several weeks or a few months or next year, but I don't think it's far away.
Isn't that the crazy thing, Steve? I mean, take the ECB. The first time they did QE and we had Draghi giving his "do whatever it takes" speech was purposely to get inflation up. And now they've got inflation up. They don't want to believe that it's up. It's like, well, you set the tools out to get inflation up. You've got inflation, but you don't want to do anything about it now. You want to ignore it. What was the point of doing it?
It's a more complex and crazy process, because to begin with, we have to go a little bit further back and acknowledge the fact that, first of all, they managed to persuade everybody by repeating the same thing, that inflation is a good thing. Then they managed to persuade everybody that having a positive inflation is a proper goal for a central bank to have. Now they've succeeded and exceeded their expectations, and now they're denying we actually have inflation.
Exactly. Yeah. It's bonkers, isn't it?
Yeah, it is. It is completely.
All right. Well, the good news is stocks are still at all-time highs, and okay. Well, I'm just getting a message that we got about 7 minutes to finish up. But the good news is that stocks are at all-time highs and they're enjoying. I mean, does higher inflation mean higher asset prices, which means you lift all boats, like stocks go higher? I mean, stocks continue to go higher. You've got. I was just looking at the crypto space. Look what's happening in Ethereum. Ethereum's up 6% today, trying to break out above. There's a wedge consolidation. We broke out, above 3350, and Bitcoin's up another percent. Bitcoin, even though we have this AB equals CD, it still looks like we're going to see above 50,000 in Bitcoin, probably closer to we'll probably say closer to 57,000. So I mean, with these higher inflationary pressures brings higher everything, right?
Yep, that's what inflation does. It readjusts nominal prices for everything. Now, historically speaking, getting hyperinflation is then negative for stocks, but we're not there yet, right? So we're still at the stage that it affects positively.
Chad just brought up that Canadian GDP is coming out right now. So heads up, can you guys read me that data?
Yeah, it's quarter on quarter for Q2. It's down 0.3%.
Okay, so the dollar Canadian
5.4%.
should spike up here, and it looks like we might break the one. Let's see if we can get a little move above 120, 125. Maybe if we can get back above 126, that would be a little bit of a squeeze there. So just a little heads up. All right, very good. Okay, thanks, Chad, for the reminder. All right, sorry, Steve, didn't mean to step on your
no problem. You did well. We had data.
So go ahead.
I had finished. I just said that, inflation is positive for stocks. Now, when it gets to the point of being hyperinflation, then it becomes a negative, but we're not there yet.
Yeah. And I wonder when, we're talking inflation, at what point does it really start to impact consumer spending? And I've got to assume that we are not too far away, at least in the US, because
it's already started, Blake, but keep in mind, and this is something important, I've said it before, and many people don't know that because it's complicated. They use different processes for different measures. Retail prices are not inflation adjusted, meaning that you're not going to see the influence of inflation in retail sales. Sorry, not retail prices, retail sales.
No, but no, I'm not worried. Forget that for a second. Forget the data. Let's talk sentiment. I mean, and that's something that's not as easily measured. When you're talking about people, which, by the way, and I'm sure this is, you've got similar numbers no matter what side of the world you're in, but here in the US, so many people are paycheck to paycheck. So what happens when everything is increasing in value and your pay is not keeping up with the rate of inflation?
Which, to be honest, has been the case literally for decades.
Yeah.
And one way it's been hidden is via underreporting inflation, as we've mentioned multiple times in the past. And Powell seems to be completely oblivious to that, because if you happen to heard the whole speech. Yeah,
but I understand what you're saying, and I really don't care about the Fed chairman. I care about sentiment. What point does it really start to crimp consumer spending when you have people that say, you know what, I can't buy McDonald's today, which I normally get McDonald's on Fridays for my family because that's our going out thing, because I live paycheck to paycheck, and that's just how we really enjoy our Friday nights. But
when they get their credit card bills from what they spent on the reopening, not worrying about what they paid for anything.
Yeah. I mean, the thing is exactly. I guess when they max out their credit cards, right? But the thing is you're getting to a point where, this inflationary pressures are really going to start to weigh on, general consumer spending. No, I don't care about the Fed not just ignoring it.
I think it's going to happen very fast once the stimulus money and all the stimulus stops being pumped into the economy, because what actually happened is that during the worst period of time that supposedly everybody would be under pressure financially speaking, the exact opposite thing happened, meaning people that were supposed to be at a very tough spot and a very tough position ended up having many of them, if we're talking about the low paid, low skilled
they were better off.
Population, they were better off. Exactly.
Yeah.
So one way or another, we're going off that period. And I think, that's going to bring the dawn of a new period, which is going to be the realization that, okay, the funny money is over, or anyhow is going to be restricted substantially. What happens now with prices being a lot higher than they used to be and incomes rebalancing back to more or less what they were, but nominally speaking, because in real terms, with all the inflation that has been going through, real incomes have drastically declined. And we've explained that in the past, that even if the Fed proves to be right that inflation is transitory, and some part of it might be transitory, by transitory inflation, what they mean, because that's the exact mathematical expression of that, is that the pace of increase of prices is transitory, because whatever increase in prices we already had, none of them is claiming that they believe that we're going to go to deflation so we can actually give back some of these price increases. They just mean that the price increases we had are already there, they're going to be staying, but the pace with which prices are going to be increasing might drop down somewhat in the future. That doesn't solve the problem that has already happened.
Well, thank you very much, Steve, for your explanation. I know Dale's got to start off with his Peters here, but before I go into that, I need to mention, guys, if you are, well, first of all, try out Forex Analytics if you're not part of Forex Analytics. It's only $1 for 10 days to try it out. Jump in our community. But what I wanted to point out is also, if you have not connected with Forest Park FX, they are a webinar sponsor. You can learn how to get Forex Analytics for free based on your trading. You can actually learn how to get cashback rebates. You can't do both. You got to do one or the other. But make sure you go through them, open your account through here, chat with them through these two channels right here and learn more about what they do. We've partnered with them for many, many years now, for nearly 5 years. They are a webinar sponsor. They are the ones that can make sure that this happens every day for you guys free. So make sure you visit them and like I said, join in the Forex Analytics community, be part of the community so we can all hang out in the chat rooms. All right, so Dale, I'm going to pass it over to you so you can take have a good interview with Peter. Thanks everybody for joining in. Ryan, Stelio, Steve, thank you guys for your comments. Of course, you too, Dale.
Good turnaround Tuesday to you, buddy. And the rest of the team and Peter Campbell, can you send me a message on chat? You said you'd be here, I think, at 5:35. So I plugged your name in. I still don't see you. Looks like the mad professor. Peter Campbell going once.
Oh, is he not here?
Not here yet. Nope.
Oh, I was thinking it was time. So
yeah, well, that's what he told me. So I'll send him another message.
Okay. All right. Sorry about that. I didn't.
That's
well,
okay.
I didn't mean to cut Steve off. I was like, oh, it's time. We got to go.
Yeah. Okay. Well, I can't control him. So
no, you can't. And you know what? It's not like it's not like you know, you bring somebody into a green room and you powder puff them and you know, put makeup on them and say, all right, we're gonna hustle you out onto the dance floor. But no, it doesn't happen that way around here. It's like either they make it to Zoom or they don't, right?
Are you here, Peter? Send a message in chat. I just sent him a message in Twitter. So I'll give it a couple more minutes. In the meantime, Blake, if you want to go, I'll just I'll hold.
Yeah, no, I mean it's fine. You know what I'll do is we are seeing a little bit of a recovery in, you know, the dollar against like the Canadian. You know, following that data, you can see the dollar Canadian took out 126. Trying to make a little bit of a recovery here, but overall, I still think the dollar Canadian's trading pretty heavy. Right now, one of the other currency pairs that I'm actually kind of focused on is the dollar Mexican peso. I'm worried that we're going to trade a little lower. You can see this little double top here. We should trade back down towards like the 1990 level, but hell, if stocks go into risk off mode, that ain't going to happen. You know, the dollar Mexican peso is one of those currencies that have developed a really, really nice base. I've made some pretty good money over the last couple months just trading the dollar Mexican peso on the long side on dips, you know, every time it gets near support. And it has really bucked the trend, the overall trend of the market. So, you know, usually as stocks are strong, you tend to see, you know, emerging market currencies underperform. That really hasn't been the case all of 2021, really, with the dollar Mexican peso. We've had this huge base. We've actually spiked up, probably squeezed out a lot of people earlier this year. And I think that the dollar Mexican peso is going to be one of those currencies that I really focus on in the event that we actually see some stock market selling, which I'm not 100% convinced we're going to get that yet. But the day that day comes, my focus will be squarely on the dollar Mexican peso. And it's not just the dollar Mex too. I like the South African rand on the short side. This is one of those that I think, can play really well, long USD, ZAR, long the Euro Mex. I think this is a good risk off type of currency pair. And you can see we've respected this lower trend line shoot since 2020. And wow. You could actually argue that we have a wedge here. So, so did Peter jump in or is he here?
I just got a message. He's coming.
Oh, he's still coming.
Signing in. No, he should be signing in right now.
Okay. All right. Very good. So anyway, there are really good setups in the FX market. I have to, and one of the last points I should probably make here regarding the dollar. Like I said, I've been trying to play the dollar on the long side. Well, I did successfully over the last few weeks. It's just last week, I gave back some profits at the end of the week.
Here, Blake.
Okay. But one thing I need to point out really quick as Dale takes over is the dollar index is still holding up very well despite the the strength that we have in stocks, and that's something that you always have to keep an eye on. All right, so Dale, have a great one. Everybody enjoy and have a great interview. I'll see the rest of you guys that are part of the Forex Analytics community on the Morning Edge in 35 minutes. So I'll see you guys there.
Okay, Peter, I'm going to promote you now as a panelist. I don't know why it's not working for me again.
Do you want me to try?
Yeah,
let me see. Peter, let me look for him.
Yeah, he's Peter.
I got him. Let's see more.
This has been going on for a week or so. Is it a different designation for me to?
I have no idea, buddy. Yeah, I have no idea. Okay.
Yeah,
but Peter, you know what? I tried to promote him and that didn't work either.
It worked now.
Oh, there he is.
Yeah,
okay.
It takes several attempts for me to do that. I'm just curious.
Yeah, it's a Zoom issue, I'm sure.
Okay. All right. Zoom. Hi, Peter. How are you? So we waited for you. You better be good today. I want to hear you. Unmute, please. Hi, Peter. Hello, Peter. Can you unmute, please?
There we are. I was speaking and nobody could hear.
Yeah, you were muted. How are you?
I'm good.
You have a note from your mom?
I do.
Okay. The dog ate your homework?
The dog ate my homework and
all right. So I'm glad you're here. And I talked to you a few weeks ago. Has anything shifted with new highs?
No, actually, that's what we're gonna go over here, and I'm gonna share my screen here. Let's see, where is it?
Finally getting a little bit of a reversal here today.
Yeah.
Okay, there you go.
So basically, this is what we discussed a few weeks ago.
What's on that Barron's cover, Peter?
That is the Unstoppable Tech.
Okay.
The Unstoppable Tech cover.
I see. Okay. So it's kind of like that triple Q commercial you see on TV. Oh, I own the QQQ. So
yeah, exactly.
Okay. All right, but the Barron's cover is classic. When did that come out? It
was last week.
Oh, perfect timing, Barron's.
So basically, we're hitting this very, very long-term channel on the S&P. We have major divergence. I'm, setting up trades around this area. Obviously, I wanted to sort of.
You kind of had a box didn't you? Where it said, I think I remember it may have been a tweet or it may have been what you had sent me on Twitter, where be short with us in a box.
Yeah.
He had an area. Okay.
Yeah. Basically, I've been building short positions here and trading around those, with longs as well. But what we see, interestingly, is that there has been a consistent pattern between Bitcoin making a lower high and markets making higher highs. And I think that that's something that appears to be looking to play out. You guys were just talking about the dollar. And even though the dollar, has consolidated a little bit since here, it still looks very productive to me. I think it seems like you would say that there's a lot of credit available, but there's actually not enough cash available, which is what I see. And, again, what I'm seeing here is also, a lot of divergences in commodities here. Oil versus S&P is a pretty big disconnect. The economic surprise index is also, really, I think the biggest divergence I've ever seen versus the market. Consumer confidence is also looking to me like it wants to go, quite a bit lower, which when you look at where the markets are is suggesting a very big problem for markets. So I continue to have a pretty, negative view of what this market is capable of. Additionally to that, we aren't really getting big buyers, emotional buyers. We're getting a lot of, very tame kind of selling into bounces. That's what I'm seeing broadly, and the tick index helps you see that. Here is this cover again, and the Citadel basically closing a lot of its big positions. And here's Microsoft, compared to Sun Microsystems in 2000, which I think is an interesting discussion because, pretty much, I don't see that there's a really big difference here, except that Microsoft fits into the narrative of the working at home technology related stuff for.
There wasn't cloud computing back then, was there?
Yeah. And, I think that, we're very much looking at a situation in which I think that the dynamics that are pumping Microsoft and pumping a lot of these other big FANG names are going to run into very similar reactions as to what happened in 2000. This is an interesting chart as well, just looking at, the NASDAQ breadth is just horrendous. And people keep saying that breadth doesn't matter. My experience is exactly opposite. If you should not be ignoring the idea that breadth and participation in this market is so bad. It's really horrendous. And it's not a sign that everything's okay. It's a sign that things are not okay. The other thing is the idea that people think repo is actually helping here. I don't know if you saw recently, hedge funds have been using the repo window to try to sort of show collateral so that they could cover margin calls that they had with this repo collateral, and that was canceled. It's part of the reason I think the market has been doing some of the weirdness that it's been doing the last week or so. But basically, repo is almost always not stimulative in the end. It basically creates marginalized assets that cannot be used for fractional reserve, where reserve assets that are on a bank balance sheet can be used for fractional reserve and then are stimulative. And so almost always when you have increasing repo activity, you're going to end up with decreasing credit activity. And I think that this is something that we're we're going to be seeing. It's one of the reasons that you see, the dollar being relatively strong now relative to what people might think. People would think, okay, well, the dollar should be weak, the dollar should be zero. But the repo activity has been holding up the dollar because it's exactly not it's not credit stimulative. It's the opposite.
Did Paul address that at all?
No.
Jackson Hole? Okay.
Yeah, this is a good article, something that, I would recommend reading, and it shows that spike in repo loans is an early warning for market disconnects. This margin debt has contracted further, and it's very negative. Additionally, on this, you can see the Chinese credit impulse moved basically 6 to 7 months forward. And you can see this is also a drag on the market, and it's going to, drag credit creation lower. And basically, the bubble we're in needs credit creation on a mammoth scale.
I heard this, Peter, and when I heard it, I was glad we were going to talk today. I'm hearing there's a pretty good chance, because of what happened in Afghanistan and people becoming already disillusioned with the Biden administration, that he may not be able to get either infrastructure bill passed, and that the Fed is going to compensate with another $3 trillion of QE. What do you think of that?
I don't think the Fed is going to do $3 trillion of QE. I think the Fed is in a very difficult spot. I think that they're going to try to be doing as little as possible, and I think the Fed, needs to unwind this bubble. Again, I want to also show that on this chart we have a beautiful.
I've been showing RSI Divergence.
And it's a channeling. So this should be, a major inflection point. Here are more,
It's today, Peter, you're on. Today's will mark the high, maybe, huh?
Yeah. And basically, these breadth disconnects here have consistently been important, whether people believe them or not. The fact is that we have essentially 5 stocks, 6 stocks, 7 stocks driving the entire market. Yeah. And I have never in my lifetime seen anything as wacky.
Narrow? Narrow? Have you ever seen a narrow?
Yeah, I've never seen anything as narrow, and I've never seen anything as, as perverse, because basically the what we're getting from 2 or 3 stocks, or 4 or 5 stocks, however they tend to be, is just enough to keep the market floating, while underneath the surface we're having stocks down 20-25% in a lot of cases. So we have this VIX is still looking to be putting in a lower basically a higher low. This is inverted, right? To me, so these are very broad patterns. Here I'm looking at.
What's the range on your box?
What?
The box to your shorting box that you had on the chart before. What's the range for being short in that box? You want to share that?
The 43s to 44s. I'm continuing massaging my short position. So, like, for example, we'll get long when there's a good time to get along, and that raises my cost average. But my goal is to be short for what I think is going to be a 40+ point decline in the market, 40+% decline.
Okay. All right.
I think it's going to be much bigger than people think. And I think it's going to be more persistent. And I'm not sure if we're going to come back. And normally I'd be looking for this. I'd be looking to come up, make this top, drop 25-30%, and then go make a new high. But the activity here has been so manic that I'm not sure that's going to be possible. Here is my parabolic top tool on the Dow, which triggered basically in June with the Dow around 35,000 or so. Now we're 35,400. The Dow really hasn't gone very far. The S&P and the NASDAQ have behaved like they're in different planets. Something I was not thinking would happen as much as that. But it is what it is. And I think, we're really looking at the markets coming back down and testing below, 3,200, 2,700 here. And here's our, consumer sentiment looking to me like it wants to see, a much bigger drop down, which would then drag the S&P. I have some weird graphics here.
Let me ask you this, Peter. Is it going to be the kind of when we start declining, could it be more drawn out than it was in 2020 with the COVID crash?
I think it's going to be slower, but at this point, I don't really know, because we've created such a dislocation here that absolutely nothing would surprise me.
Okay, everything can happen now.
I think that, we have a major credit crisis. That's the problem. So
then why are junk bonds making new highs or retesting the highs again? Now the corporates aren't LQD, but HYG is pushing the high. If there's a credit crisis, why is junk outperforming corporate and
because
LQD?
It's called dumb money.
Okay.
And
because isn't the corporate bond market the biggest bubble that we have going on here with what's happening?
It's a huge bubble, and I think that this bond situation is emblematic of a major problem where people are just way too optimistic, and you have late FOMO crowd people coming up and chasing the last dregs of something that's pretty much over. And here's another look at breadth, for example, and this is the biggest breadth non-information I've seen in my 30 years in the markets.
Wow.
And then again, here we are back at this chart, and I think we are very similarly channeling here, retesting this area, doing a throw over, and I think the side effects from this particular setup and the situation are going to be long lasting and probably proceeding into a market that is a downward market for the next several years. That's my view from this. I think personally, I've never seen anything as wacko as what we're dealing with right now.
No one has. Yeah. And people may not know that it's unusual. And that's why I'm glad I had you on to kind of point out different charts that make this seem, show that this is unparalleled, what we have here. I know, maybe 1929. Is that a good analog?
Yeah, I think it's worse than
or 87.
No, much more 1929.
Okay. All right. And what vehicles do you use for taking advantage of the short side futures? Any
futures,
ETFs that you?
Pretty much futures only. So,
okay. All right.
The ES futures, Dow futures, etc.
Okay. All right. Well, I appreciate you being here, Peter. Why don't you show your website or the best place for people to follow this narrative, possibly, want to work with you?
You can go to find me over here.
Okay.
MCM_CT. And then there's also MCM_.
Your private Twitter feed?
Yeah.
Okay. All right. So that's how you mainly communicate your ideas nowadays, is through your private Twitter feed?
Yeah.
Okay. Well, you're getting some good response to what you did today. So, I want to thank you, my trading warrior brother. Maybe we should have you back near year end and see how this whole thing played out, huh?
It's going to be a very interesting end of the year for sure.
Yeah.
And I think, we're going to see quite a lot of activity, I think, in the markets. It's going to be
and I'm told that, Peter, I don't know if you're you know, you're married or you have kids or you have nephews and nieces, but I'm told that you have to go buy your Christmas gifts now because of the supply chain issues. There won't be much on the shelves. And you told me, and you told me the last time I talked to you to go to Target, and you know, if there's some things you need, you know, Americans aren't used to the inconvenience of not being able to get what they want immediately. And I actually had real life experiences with ordering furniture that, you know, they said, okay, yeah, Mr. Pinkert, you might be able to get it by the end of September. And
Yeah.
that was a few weeks ago. So it's real what's
Yeah.
happening here with, you know, so if there's anything you like at Walmart or Target, don't order it online, you know, just go in and pick it up while it's still there.
Yep.
So I'm looking for your Christmas gift, Peter, and I think I'm going to look for, you know, some type of bear related item for you. Okay. So, all right. So
Okay.
thanks, partner, for
Catch you
being
later.
here and showing your work. Great work, Peter.
Okay. Thank you.
Appreciate it, buddy. All right, everyone, that's Turnaround Tuesday. Hope you enjoyed that interview with Peter the Bear Campbell. And we'll see everyone tomorrow. Good hunting. You could join the team in 14 minutes for the morning edge. All you have to do is sign up. You have time to sign up and catch Blake's bias chart, everything. So take it easy. Don't just count, you know, your VIX and your breath. Count your blessings. And I'll see everyone tomorrow. Thank you, Steve. Adios. Adios, Laura.